last few episodes of Commodity Classroom that we do every Friday at 4 p.m., we discuss the evolution of commodity trading, ways and means of investing in commodity market, and also delve deep into the commodity cycles. Today on the show, we will now shift focus to the three components of total return, risks involved in commodity market, and we will also understand who regulates commodity trading and how is it actually done. To discuss all this and more, we now have Anuj Gupta, Head Commodities and Currencies at HDFC Securities, now joining us. Remember, he has been tracking the commodity market for the last 20 years. But first up, before we start our discussion, let's understand the three main components of total return in commodity trading. That is spot return, collateral return and roll return. Spot return is the change in value of underlying commodity. Collateral return, meanwhile, is the yield on securities that the investor deposits as a collateral, while roll return is the difference between the price of near-term commodity and a far-term commodity contract. Mr. Gupta, wanted you to understand your thoughts on what this means on the concept of spot, collateral and roll return in greater detail. What is the significance of each of this, and why is it important to understand all of these components of total return?
Hi, good afternoon. See, in commodity market, there is a three types of trading which is available in the Indian market and not on Indian market, even global market. One is the physical market. We can say that that's the spot market. Second one is the futures market, and we can say that there's a futures market. And the third one is the the rollover cost, right? So if you talk about the spot market or physical market, we are as Indian is the agriculture in the economy, so there is a lots of farmers, there are lots of trader who are trading in the physical market. So who trading in physical market and buyers sell commodity in the physical or in spot market, let's say in the mandis or in the physical market. So if they are trading in the market and earning from the market, so we can say that this is a spot market where they buy commodity in physical form and sell commodity in the physical form. So the difference between a buyer and sell in the physical commodity, that's called the spot return. Or we can say that traders are doing trading in the physical market, or mandi, farmers and artiya, they are all the player of the spot market where they are doing trading in the physical market. And even we have seen many exporter, importers and manufacturers, producers are doing that kind of trading to build up the main product. So generally we have seen that many people are doing this kind of trading which is based on the realistic commodities. And if we talk about the collateral, the return or the futures market, that is based on margin trading, which is available on the online exchanges. As we know that MCX is the exchange, or NCDX are the two exchanges which are providing the trading in the commodities on the base of collateral, or we can say the margin. So MCX generally is known for the international commodity, and NCDX for the agriculture commodity. So both the exchanges, we have seen lots of commodity are listed just like NSE and BSE. So the collateral the trading or collateral return are those type of returns where investor deposit the margin or deposit the collateral, and on that behalf they trade in the commodities. So the difference between the buy and sell on the the futures market exchange or exchange trade, that's called the collateral return. So basically somehow, as in spot market we required 100% amount to buy or sell commodity in the physical market, but on the collateral return we need 10 to 15% kind of margin to trade in the commodity. So basically collateral return is based on the futures market, or there is some specific date where we have to square up the position. So the if you compare the return between spot and the collateral, so generally the collateral return is higher than the spot market, because
Understood.
spot required a full amount. And if you talk about the rollover return, that is a one kind of trading strategy where traders are using the exchanges to trade in the commodity. We have seen that there are two type of the rollover return. One is contango and the backwardation. When the future price is higher than the spot price, that is called the contango, and when the future price is lower than the spot price, that is the backwardation. So the difference between the current price and future price is called the rollover return, or we can say that this also the spread trading kind of thing. So these are three types of market in the commodity market where trader are using to catch the returns.
So those are the three different types of returns and components of total return. But Mr. Gupta also wanted your thoughts on the risks involved in commodity market, especially when compared to equity. We understand price volatility is a factor which impacts both equity as well as commodity, but several other factors also impact commodity. Say for instance, technological changes, weather, political risks globally, etc. Help us understand how do we assess those?
We have seen many geopolitical tensions across the globe. We have seen political unrest as well, and we have seen weather unrest also. So all the factors which are whenever they occurred in any global market, they affect the commodity. Because if you see, commodity market is the biggest market, and we consume the commodity. So whenever we saw any unrest in any area in the globe, we saw the risk factor is there. But if we talk about the trading side, definitely the environment, weather, these are the main factors: geopolitical tension and political unrest and the price volatility. Because if you see, everybody is using the commodity, every economy is using the commodity. We importing, exporting the commodity, we consuming the commodity. So the commodity market, the risk associated in the commodity market is very high. But yes, definitely the price volatility is there. So price risk is always is there. So the risk in the commodity market is very high as compared to the equity.
Commodity market is very high as compared to equity. And one last question, who regulates commodity market? Is it SEBI, and are regulations very similar to equities?
See, earlier it was regulated by the FMC, but after the merger of FMC and SEBI, now SEBI is regulating. So almost the regulations are same, but since it's related to the physical market, so there is a lots of the regulation more than the equity market, because there is a quality of concern. There is a regulation of the exchanges, because two exchanges is there. They are also a physical market, so regulator should look after to the physical market as well. And even as this is a very volatile market, so definitely SEBI is looking towards the investor protection also. And also, there is a lots of unethical players in the market also. So SEBI is also looking towards the regulation of the participant, regulate to the exchanges, regulate to the the clients, regulates to the market participants. So SEBI is doing a lots of work to regulate this market. And even we have seen the increase or decrease of the margin is also regulated by the exchanges. Price fluctuation is also somehow looking towards the exchanges and the SEBI also. So SEBI is basically regulate the commodity, and the regulations are more than the equity market.
Regulations are more for commodity as compared to equities. Mr. Gupta, thank you so much for taking your time out and speaking with us here on ET Now on a whole host of issues.
If you like this video, then like, share and subscribe to ET Now.